All right, so we welcome you again to another discussion. So in this particular discussion, we focus on preparing general ledger accounts. So as we have discussed in the previous sessions, we have explained to you, or rather we have defined for you what a general ledger is. All right. So we say a general ledger is like a folder. All right. So a business is going to have expenditure and get income. So there are certain items of income and expenditure that we would like to track over the year. We want to have an idea at the end of the year, how much did we spend on this particular expenditure line. All right. So for example, let's say you have a small business that does transport. All right. So it's a small transport business. So let's say that you transport people's goods from point A to point B. So there are things that you, as the owner of the business or as the manager of the business, you want to track. All right. For example, let's say you have services like you have taxi services, right? You can have haulage services where you transport, let's say, furniture or from for a retailer from point A to point B. Let's say you have what else can you have here? All right, so let's say this is Uber, right? Not so that, and this is public taxis. So you see that you're gonna get income from each of these streams. They are called income streams, right? Or sources of income. Or if we want to be more technical, it's sources of revenue or revenue streams, right? So you might want to know at the end of the year, how much did you get from your Uber or Bolt services? How much did you get from your haulage services? And how much did you get from your public taxes? So which means that you are going to open an account for each of these, which we refer to as the general ledger account, right? So each time you get something from a public taxi, you're going to record it. For the month of January, you record it. For the month of February, you record it. And at the end, you have a total, let's say in December. All right. Of course, you know the financial year doesn't have to be from January to December. That's the calendar year. The financial year is basically 12 months. So if we start in January, the 12 months ends in 31 December. All right. So if we start in February, then the financial year ends in 31 January of the following year. If our year starts in 1 March or on 1 March, then it's going to end on 28 February of the following year. Just 12 months. So you accumulate every income that you're going to get from this, you're going to accumulate, right? Then you also open an account for the haulage services. When you transport people's goods, furniture from this house to there, when people are moving, right? So you're going to record each under its own general ledger account. So a general ledger account is, could be income or expenditure or anything that we are interested in, right? So we need to know. So we record each time there is an increase or decrease in that item of interest, then we need to record it. So let's say we are interested in knowing how much fuel we spend. So that's going to be an expenditure, all right? So what are we going to do? Then we open an fuel account in the general ledger. So each time we buy fuel, right? Let's say each time we buy fuel, we're gonna record that in the account, in the general ledger account, so that at the end of the year we have an idea of how much fuel we spend, how much we spend on salaries, how much we spend on compensation for accidents, how much we spend on licensing, how much we spend on training, how much we spend on repairs and maintenance of our vehicle. So we're going to open an account for everything that we think is important enough for us to track the movements. All right. So because it's transport business, so we're going to open an account for, say, Uber assets, Uber car, Uber vehicles, right? So each time we buy a new vehicle, we're going to record it. Right? We want to know what's happening to our vehicles. If we sell, we're going to record. So at the end of the year, we can have a complete history of what happened to our vehicles that we use for Uber, what happened to the vehicles that we use for haulage. So we can also open a motor vehicle account, Uber, motor vehicle account, haulage, motor vehicle account, public services, public transport. So we said to you the other day, if you look at all these elements of the basic accounting equation, where we have assets, or which is the basic accounting equation where we have assets being equal to equity plus liabilities. So we gave you earlier on a list of current and non-current assets. Now, all of these are examples of general ledger accounts, right? Because we are interested in knowing how much vehicles we have, how much prepaid expenses we have. Then we also have expenses and income, where we are interested in knowing how much sales did we make. So each time we or services rendered, so each time we do render a service or we make a sales, we're going to record it there over and over. If we are going to have rent, we need to know how much a rent. So each time we pay rent, we're going to record it, right? Advertising, okay, insurance, repairs and maintenance. So all these are going to be general ledger accounts that are opened in the accounting system. So we have an accounting system, so you can open many accounts based on how what you want to track and what you don't want to track. So when you open an account has rules. A general ledger account has rules. Depending on the category it belongs, some general ledger accounts belong to assets. Some belong to drawings or capital. Some belong to expenses. Some belong to income. And eventually some belong to liabilities. So for each category, all right, so we have 5 elements of the basic accounting equation. And those 5 elements are going to be your assets, your equity, your income, your expenses. So this is equity, your expenses, and your liabilities. So each of these has rules that are followed. If you are recording a general ledger account that falls under assets, you need to know if there is an increase in that general ledger account. Let's say it's a motor vehicle account, and I've just bought another motor vehicle. I need to record that. All right. It's an asset, and a general ledger account is also called a T account because it's something like that. And it has 2 sides. One is the debit side, the other is the credit side. So you need to know which side do motor vehicles increase. All right. So that when you come to a motor vehicle account like that, if you buy a motor vehicle, you need to record it to the correct side. If you sell a motor vehicle, you need to record it on the correct side, so that at the end of the year, you can have a complete and accurate history of what happened to your motor vehicles, because you want to track the motor vehicles. That's why you opened an account for motor vehicles in the general ledger. So what we're going to discuss here is the general ledger format of the T account. All right. So the T account is a debit side and a credit side. All right. So we have those 5 elements of financial statements, and we have elements that increase on the debit side. Then we also have elements that increase on the credit side. So there's an acronym that students use, which is called the dead click. So the first D wants to tell you which items are going to be on which increase on the debit side. So we have to see if there is an increase in something and it falls under this the dead side of the dead click acronym, then we need to know that it's going to be recorded on the debit side, right? So if drawings increase, you record them on the debit side. You record the increase on the debit side, right? That's the first D. If your expenses increase, they're going to be recorded on the debit side, all right? If your assets increase, they're going to be recorded. The increase will be recorded on the debit side. So what this means is all elements that increase on the debit side will decrease on the credit side. All right. So if it is an asset, then we have something like this. All right. This is the debit. This is the credit. So the plus is on this side for an asset, and the minus is on that side for an asset. So if we identify an asset under our asset section here, or whether it's furniture. So if we, let's say we sell furniture. So basically our furniture has decreased, right? And because furniture is an asset, we will remember that we're going to record that decrease, the amount here. The furniture that we removed is going to be recorded on the credit side. And if you buy more furniture, because it's an asset, we're going to record that increase on the debit side. So the items that increase on the debit side are your drawings, your expenses, and your assets. And they increase on the debit side and they decrease on the credit side. Okay, and if we come to the credit side, which is the click, the items that increase on the credit side is capital, the contribution by the owner. So liabilities, the borrowings that we have, and income, all right, it's going to increase on the credit, all right? And which means that all the items that increase on the credit side will automatically decrease on the debit side. Okay, so what are we going to do in this particular example? So I'm going to give you an idea of how to construct a general ledger account, the rules that are followed. So the example that we're going to give you is, all right, so this is part one, right? So in part one, I'm going to show you how you construct or how you prepare a general ledger account, the bank account, right, which is very important. So when we talk of the bank account, we open our own account that will record transactions as we receive money and pay money. We're going to record that. So the bank is going to also make its own records there, whether we bank with ABSA or FNB. We don't know what the bank is doing on their side. But for our side, we want to keep track of the things that we know. If we pay, we record. We pay, we record. We receive money, we record. And then we will always check with what the bank is doing. All right. So if there's a difference, we have to reconcile the difference. So the bank account we're talking about is the bank account in our own accounts, in our own general ledger, the records that we keep. So that's the bank account we're going to prepare. Right. So the first thing you need to remember is that the bank, right, positive balance is going to be, so the bank generally is an asset account. All right. So if you record if you want to open a general ledger account for bank, know that you've opened a general ledger account for an asset. But sometimes bank is affected by the balance, If the balance is positive, then it's an asset. And if the balance is negative, then we have a bank overdraft, and it's a liability because we owe people now in our bank account. Brilliant. So let's start with the construction of the bank account in the general ledger. All right. So this business, Mr. Furniture Traders, buys and sells used furniture, right? So that's what they do. All right, so let's look at the transactions that happened. Remember, we are going to construct the bank account. And when we construct the bank account, we are interested in those transactions that increase or decrease our bank account, right? So we are going to pay attention because not all transactions are going to affect the bank account. So as you will see, so the first one is the owner contributed cash to start the business. So he contributed 100,000. So the owner contributed 100,000. So remember, the business received cash of 100,000 from the owner. All right. So the money in the bank account is increased by 100,000. Because bank is an asset, it increases on the debit. So we're gonna come and record it like this. On the 1st of March, right? So we open a bank account. So this is the debit side. This is the name of the general ledger account. This is the credit side. So here we want the date. Okay. Here we want the details. So the details is the other leg of the double entry. Right? Then the folio is we're gonna use the folio here for the journal that was used. And of course, for when recording the bank account, it's always the cash receipts journal or the cash payments journal. And journals is a topic that we normally cover a bit later when we go into depth with that journals. So the credit side and the debit side have the same format, right, and the amount. So remember that on the 1st of March, the owner contributed 100,000. So our bank is an asset. So on the debit side, all right, this is the debit side, we record that 100,000, and it's recorded using the cash receipts journal because the business received cash. It's not just anything, it's a cash received journal. And this cash is coming from capital contribution, right? So this is the other leg of the double entry. So if you want to do a journal, sometimes they want you to demonstrate how this was done, all right? How this is done in the journals. So you would say bank, if you are going to make a general ledger entry in the journal, you would say bank is 100,000. And then you have capital is 100,000. Right, like that. So which means that basically this is saying that the account that was debited is the bank account with 100,000. And then the account that was credited is the capital account with the 100,000. So that is our double entry. So remember, for every debit, there must be a corresponding credit. All right. So if we make a debit entry here, right, or if we record this amount on the debit side, which is called making a debit entry or debiting bank with 100,000, we must also write here under details the other account which was credited. Here we have debited bank because this is the debit side, and we record 100,000. Then on the details, we have another account which was credited. This is called a contra account. That's called a contra account. So if we have a debit entry, then the contra account is the credit entry, where the credit entry was made. So the credit entry was made in the capital account in this particular case. All right. We received cash, we debit. So each time we receive cash, we debit the bank. Each time we pay out of the business bank account, we record it under bank as well. All right. So those are the only transactions that we record in our bank account. So if money doesn't come into the bank account or doesn't flow from the bank account, then we're not going to record it in the bank account. An example is we pay by credit card, right? So we did pay, but not using our money. We used somebody's money. So that's not our bank account. That's the credit card. So it's different from the bank account. It's also different when we pay using petty cash. You know, petty cash is the money that we keep at the office for small things. All right. Like if you want to buy groceries, you really you can't transfer, you can't do EFT to Pick and Pay, right? You just count how much money you give your messenger, 3,000 to go and buy. All right. So because that money is not coming from the bank account, but from the petty cash account, it won't be recorded under bank. So you have to be paying attention whether the money was actually received in our bank account or whether the money actually went out of our bank account. Those are the things that we want to record. So far, we record this capital contribution, right? Then we have number 2. We paid office rent for the month. This is 15,000. Right? So we're going to debit rent, because we are recording rent every month, right? So our rent has increased by 15,000. We want a record of the, or a full history of the rent at the end of the year. So each month we're going to record a rent, because a rent is an expense. It's going to be recorded on the debit. But remember, we are constructing the bank account only. So you're going to leave the portion of the rent, and construct the bank account. So we're going to credit the bank account because this money went out. All right. So we come here and say office rent. This is the contra account. It's called a contra account, or the other leg of the double entry. Because we're going to credit bank, we need to, under the details, we're going to write the name of the account which was debited. So, of course, because we did make a payment, it's the cash payments journal. All right. Then we go again. Then the owner contributed furniture and fittings to the business. But this has nothing to do with the bank account. So if you look, what effect did this have on the bank account? Nothing. So because it's not about the bank account, we're going to ignore it. However, we just for our enrichment, we would debit furniture. All right. Because it's an asset that is increased. Our furniture is increased. And the owner, because it's a contribution by the owner, is going to be capital, which is also credited. So we bought furniture on the 11th for resale on account. Now, this is something that a bit interesting, and I will explain to you how that works. All right. So we bought on account means we did not pay cash. So if we didn't pay cash, that means it doesn't affect our bank balance. All right. So it's not going to work. We're not going to be recording it in the bank. However, this furniture is for resale, right? So we just want to understand the principles around that. Because this is a company that does buying and selling of used furniture. So we buy on furniture for resale, means this is going to be inventory. It's not going to be classified as furniture it's not going to be classified as furniture, right? Because it's for resale. So if you buy things for resale, regardless of their nature, they are going to be called inventory. All right. But if it was for use, for example, here we purchased furniture on cash for business use, this will be classified as furniture, not inventory. Okay. So we also need to know for what purpose something was bought. So back to construction on number 11. This does not affect the bank account. But on the 15th, we paid for some furniture. We paid, right? Right. For some of that furniture which we bought on credit. So we paid 15,000. And every payment is going to be on the credit side. Because bank is an asset, it increases on the debit, it decreases on the credit. So if we pay, it means the bank account has decreased by 15,000. And the decrease is on the credit side. So we're going to record this 15,000 on the credit side of the bank account. Right. So I'm going to come here. But I remember I'm paying for the furniture that I bought, all right, on credit. So that's called, we are paying our trade payables. All right. So the other leg of the transaction is to debit trade payables, credit bank. So if I come here, where is that? Sorry, there is the 15th. All right, my apologies. I confused the dates, right? The 19th is, so this is the 15th when we paid the trade payables. All right, 15,000. All right, that's good. And then on the 19th, we paid, or on the 16th rather, we sold furniture for cash. So we received, right? So obviously, whenever we receive cash, we debit the bank account. But because this is furniture that we sell, it's going to be part of our sales, right? So we sold furniture for cash. So we received 25,000. So I'm going to come and say the other general ledger account that was credited is the sales account, which is the contra account. And we received cash, so we're going to debit the bank account. Right? So I hope that makes sense to you. If you are new to accounting, you obviously need a little bit more time to try and construct, but it must make sense. It mustn't be altogether confusing. Then on the 19th, we purchased or bought furniture on cash for business use. Because this is for business use, not for resale, it's called furniture. It's an asset that we want to use it, not for resale. And because we purchased furniture on cash, that's what we care about when constructing the bank account. So it's going to be cash here. This one, all right? 20,000. It's furniture. We debit furniture and we credit the bank account. Right? What else do we do? Then we purchased furniture on cash for display. What was that? Purchased furniture on cash on the 20th. That's 100,000. All right. So for displays, obviously, because we want to sell, right? So we want to display to people. So that's going to be part of our selling stuff. So that's going to be 100,000 that we're gonna record there. Then we got a loan and contributed the money to the business. So I put in this question because it happens a lot. So what we care about, remember, if you've been following our explanations, we have what we refer to as the entity principle. So the entity principle says that we record transactions that the business enters into only. We don't care about the transactions that the owner enters into. So Tsepo is the owner, right? So Tsepo got a loan. So we don't record that loan because it's a loan by Tsepo. We don't do the accounting for Tsepo. But now that money was contributed to the business. So all we know is that the business received money from Tsepo, but we don't want to know where Tsepo got that money from. So this is not going to be a loan, right? It's going to be capital because we just record the transaction between the firm and the other party, right? So it's between the business and Tsepo, not between the business and the supplier of the loan, because the business did not get the loan, right? The business did not go to apply for the loan. So there's no transaction between Tsepo, between the loan provider and the business. But there's a transaction between Tsepo and the business. So Tsepo is the owner. He contributed cash. That's all we care. We don't care where he got that money. So it's going to be 50,000, and we're going to say that is capital, right? And so Tsepo used the business bank account to pay for his wife's telephone expenses. And we have explained to you earlier that this is drawings. So the money went down as a result of the drawings. So I'm going to say drawings here and 3,000 on the credit side, because the credit side for bank means we are paying, our money is being reduced. And then we paid salaries and wages for the staff. That's 40,000. So when we pay, the money goes out, the bank balance reduces, the asset decreases. So we're gonna record this 40,000 here under salaries. All right. Okay. And when we say under salaries, we're saying that salaries is the account that was debited with the 40,000. So it's debit salaries, credit bank 40,000. Debit drawings, credit bank 3,000. So we debit salaries, remember, because salaries is an expense. So we want to record that we have incurred the expense for 40,000, and in April we record again on the debit side of salaries. Each time we have to pay salaries, right? We're gonna record them so that at the end of the year we know how much we paid in total. So we have a side that we record. We have rules that we follow, right? And we paid for fuel using the business credit card. Because we use the credit card, all right, it's not money, it's not our money, it's somebody's money. So this money didn't go out of our bank account. So this 1,000 rand did not affect our bank balance because we have a credit card, we use somebody's money. So we're going to debit the expense, credit the credit card, all right? Or maybe we can open an account called ABSA credit card, then we're gonna record there. So this is not going to affect our bank account. Then we received money from the debtors. Now the debtors are those people we sold for on credit. So they don't pay us immediately, they pay later. Because they pay later, we're going to record this as cash received from trade receivables, not from sales. All right. Because the sales portion, we already recorded it when we say debit trade receivables, credit cash. Debit trade receivables. So let's just look at a quick transaction. So when we sell on credit, we're gonna debit trade receivables. All right. Then we credit sales. Because sales is income. If we make a sale, our income is increased. But the people haven't paid. So that's why we record them under debtors. But now they eventually pay. So our debtors are actually decreasing. All right. It's an asset that has decreased. So we're going to debit bank because we have received cash. But we're going to credit trade receivables because they are reducing there. As they pay, their amounts reduce. So we come here and say trade receivables control is the account that was credited as we debited bank account because we received this 15,000. Now, these are all the transactions that we had. So the next step after picking up the transactions that affect the bank account, then we're going to do what is referred to as balancing of a general ledger account. So the balancing normally works, normally it needs effort if you have entries on both the debit side and the credit side, right? Like this. So you have to do calculations and say which side is bigger than the other. So you have to do the totals for the debit, right? And the totals for the credit. The total for all your entries. So if we start with the credit side, then we're gonna have 15,000. All right. Plus 20. This is the 20 plus another 15 plus 100. Plus 15 plus 100. Plus this 3 and a 4. So that's plus 4, 3. So I get 193, right? Right. Right, I get 193. Then I do my calculations here. I get 100. Right, the first one plus a 25 plus a 50 plus 15. So I get 190. So as you can see, this side is 193. Right, this side is 190. So the smaller side is the debit side. So on the smaller side, when you are balancing your general ledger account, like at the end of the month or at the end of the year or whatever you're doing, you have to balance the debit and the credit. Because the debit side is smaller, the balancing amount should be on the debit side because it's the smaller side. So we want to balance them so that they agree. So the totals for both sides are going to be based on the biggest of those two amounts, all right? So the highest amount is the 193. It's going to be the total for both sides. But then so that we also get to 193, we need an extra 3,000 here. That's the balancing amount. But it's the balance carried down because we're going into the next month. We carry it down or we carry forward into the next month, the 3,000. So if the balance is on the debit side, the balance carried down or the balancing figure is on the debit side, then the following month, April 1, is referred to as a balance brought down on the other side, on the opposite side. Because it was on the debit, it's now on the credit, right? To say that our bank balance brought from last month is an overdraft of 3,000. We say it's an overdraft because it's an asset called bank, which is a credit balance. So it means that we overdrew our amounts, right? And that's why it's an overdraft, and that's why we would refer to that as a current liability. If the balance brought down was this side, then it would have been an asset. It means we had a debit balance, a positive balance. This is a credit balance, a negative balance with 3,000. So basically, that's how you construct a general ledger account. You're going to record based on the rules of the dead click, right? Then once you've done the recording, you need to do the balancing. All right. So basically, that is what you will be tested on. So what I would like you to do is, why don't you practice this by yourself over and over, maybe 3 times, all right? Try to see if you can construct on your own, if you can get that balance. Because once you know how to do that, then it's going to be easy. So this was just part 1, all right? So I'm going to have another part 2 and part 3 to help you prepare general ledger accounts. Then after that, I would expect you to know the language and speak as many phrases and words as you can. All right, so for now, we're going to stop here. Watch out for part 2 of the general ledger accounts and part 3 as well, and so that you can perhaps have a complete understanding of the concepts.